Good afternoon. Here we are again, ready to go forward with some more ideas on this basic structure. So far we're still working on the basic structure, and you're going to be able to see an insert here that shows you what we're looking at, so you kind of have an idea of what we're talking about. So far we talked about corporation getting any excess monies into the limited partnership. Why? Limited partnership has a much wider and broader purpose, and thus more things are going to be tax deductible under the limited partnership than under your corporation. And the two places that we're going to go to get tax benefits during your lifetime are the corporation and your limited partnership. Okay. Now, we're going to talk later when we get even a larger structure. We're going to talk about in California and out California assets and how we handle those and how we work with that. What if you have multiple entities in different places? We're going to talk about all that, but that's not tonight's topic. Tonight's topic is we've started to make sure that all this money is coming into this pot we call a limited partnership. And now it's there. We have to do something with it. Otherwise, we're going to get a K-1 that requires us to pay tax on it in the end. Okay? So we talked last time about using it for travel. We talked about using it for eating out. Okay, so we just talk about what a business needs to be in business, because those are obviously going to be tax deductible, right? So my first thought is, do we need a phone for a business? And the answer is yes, of course. You can't run a business without a phone. Well, guess what? Your cell phone has just become tax deductible because we're going to use it for the business. How about internet access? You have to have internet nowadays to run a business. That's going to become tax deductible. Okay, what if you wanted to put money into the stock account that your limited partnership has? Is that going to be tax deductible? No. Okay, how do I know? Because I asked my CPA, and he says you don't get to do that because there's a law that specifically says monies put into a investment account are not going to be tax deductible. Okay, so I don't do that one. Okay, well, let's talk about what if you want to deal in jewels. Okay. Well, if a corporation that is a jewelry store, if it buys a jewel, is it going to be a tax deductible expense? Yes, it's part of the inventory, right? And we like that word inventory, because if it's inventory, it means it belongs to the business and it should be tax deductible. So the deal is that what if my limited partnership wants to invest in investable jewelry, okay? Now, I'm not talking about, little $500 or $1,000 rings. I'm not talking about your pearl earrings that have, a $50 value. I'm talking about something that is substantial, okay? You're going to buy a $5, $10, $15, $20, $40,000 jewel, either however it is hit, because you know that this jewel is going to go up in value. It becomes inventory. Now, to do that, we have to put within your limited partnership that we're going to be working with jewelry. We're going to not jewelry necessarily, but investable jewels, okay? Investable things like that. And so by putting it in there and actually doing that, it becomes part of the purpose of the limited partnership. So we can start doing that. Now, this is one that you have to do in the correct way. If you do it wrong, it's not going to work, okay? Because just buying a ring for your wife and saying the limited partnership owns it is not going to necessarily make it a tax deductible expense. It has to be done in the proper legal way. And so we would want to, if we're going to do that, we're going to take care of that. Now, I had somebody come in the other day. They said, what about my Bitcoin? Okay. Well, we know a few things about Bitcoin. Okay. Number one, and it's not just Bitcoin, but it's Ethereum and Litecoin and all the different, cyber monies that are out there. Okay. And so the deal is that you can't generally transfer those into an entity if they're already in your name. Now, you can open an account that's in the name of an entity, and you can go ahead and purchase that way. But if you already have, some cyber currency, that you're not going to probably be able to transfer it in. But if you look on Coinbase or on Kraken or wherever you're holding your cyber currency, they're going to go ahead and have a number on the account, and you can make sure that on your list of assets in the limited partnership, those numbers are listed, or they say all cyber currency is in my trust, and then you have those in a safer place. So the deal is, yes, you can do that. What the tax ramifications are all up in the air right now, to tell you the truth. Nobody's quite sure what's going to happen on that. But I have mine listed on my limited partnership list that says my cyber currency is all in my limited partnership. Now, what about if you wanted to buy that boat we talked about? Well, definitely. I mean, that's personal property you can lease. So you buy it. Now, what happens? You're going to have to lease it from yourself. All right. So the deal is, if you go take that boat out for the weekend, you're going to pay the limited partnership $150, $200 for the lease of that boat for the day. But guess what? The limited partnership is going to pay for the mooring fees, and it's going to pay for the gas, and it's going to pay for the maintenance, and it's going to pay for the registration, and it's going to pay for the boat. All those different expenses that come with that boat are all going to be paid with this non-taxed money that you have in the limited partnership. But you do have to actually lease it. You can't just sit and say, I'm going to say I leased it and I didn't. Well, now we're going to tax evasion again. We don't do that. You actually have to pay the money. Okay, I'll give you an example. In my limited partnership, I have my house. And it's been in my limited partnership probably for 20 years or something like that. Now, the house is a limited partnership asset. And so the deal is, because it's a limited partnership asset, I actually pay a rent on my house. Okay, I pay rent of $2,000 a month to use this house every month. And I've been doing that for years and years and years. And for that house, for what it's be able to be used for, is a fair rent. Now, I will tell you this. If I fix the fences and I could keep cows and horses in there, the rent could go up. But you know what? I don't want any cows and I don't want any horses. And so I keep the fences down. The rent keeps the rent down also, because it makes the value of property a little less valuable there. Now, for several years, many years, I was paying I had a mortgage of $3,000 a month. But I was paying $5,000 a month just to pay it off sooner. My opinion on mortgages on houses is you need to own your own house, so nobody can come and take it away from you. And I know there's all kinds of thoughts about what about the mortgage credits you get and the mortgage interest credits and all that type of thing. I'd rather have the house paid for, because that interest credit isn't anything near to what I'm having to pay for interest on that house. So the deal is, I was paying extra on that. Where did the extra money come from? It came from this money that came from my office. Okay, it came from rents from the other properties. It came from other sources that went into the limited partnership, and I was able to pay for this excess on the mortgage in a way that can be seen as tax deductible. Now, you need to work with your CPA on that to make sure that that they understand how that works. Okay, that it's not just a mortgage interest, not just depreciation. You can actually have it so that the expenses on the house can be tax deductible in certain ways, but you have to do it in a certain way, or else it's wrong and you're going to get in trouble. And you don't want to do that. So the deal is, do it the right way. So that's one of the things I'm able to do. I had to replace my refrigerator in my house a couple years ago. I was one of those silly people that actually put in a built-in refrigerator. Never do that, in my opinion, okay? Instead, get a regular refrigerator and do that, because the built-in is like 3 times more expensive than a normal refrigerator is. Anyway, we had to put this refrigerator in, and who paid for the refrigerator? The limited partnership did. It was a rental for the limited partnership. I've had to pay for dishwashers and stoves and refrigerators in other rentals that I have. It's just like the same as this one. I had to pay for this one. I pay for somebody to go and do the yard work on one of my rentals in Sacramento. Well, guess what? I pay for the guy to do the yard work at my house, because it's a rental also. And so that's going to be tax deductible because it has to do with assets owned by the limited partnership. So these are the kind of things you want to think about. what I do with my clients is after we set this up and we train them how to use it, and they go home and they forget everything I told them, and then they come back and I train them again, and they go home and they're doing a little bit better, we meet one more time for what we call an array meeting. Now, an array just means a whole bunch of little boxes, okay? It's just like for those of you who are old enough to remember the old green sheets we did our accounting on. It had, you'd put, January 1st, 2nd, 3rd, 4th, 5th across the top, and then you'd have, this is the expense for this is the expense for this is the expense for this, and you'd be able to keep it track. That was an array. And we do the same thing with our clients. And we go through and say, okay, what does my corporation own? What does my trust own? What does my limited partnership own? What does my LLC own? And what do I own personally, like IRAs, 401ks? They don't go in your trust. So the deal is we have that on one side, and then across the top, I have what expenses do I have for each of these? What income do I have for each of these? And so we go through that. We actually look at what you spend money for already, so we don't have to make something up and have you spend money for things you're not already using it for. We find out what you're spending the money for already and see if it fits into any of the boxes that could be tax deductible. Does everything fit? No. You go to the grocery store, that's not tax deductible. You go and buy presents for the grandkids, that's not tax deductible. You go to Disneyland, that's not tax deductible. So there's things that just will never, ever be tax deductible. But there are other things that you're already spending money for, and you're paying it with post-tax money, which means money that's already been taxed. And so you're paying for it with less than what you had. I'll give you an example. Let's imagine that I want to buy a Rembrandt picture, and I found this great deal, and somebody wants to sell a Rembrandt for $20,000. And I'm thinking, this is a great deal. I think I really need to do that. So I've got two options of what I can do to buy that property for that picture for $20,000. Number one, I take what's left over from my income, my salary from the law office, and so I have to earn $32,000 so I can pay $12,000 in taxes and end up with $20,000 to buy the Rembrandt. So it actually cost me $32,000, not $20,000. Does that make sense? Okay, so another way I can do this is I can go ahead and go to my limited partnership that has money came in that has never been taxed. I can buy this Rembrandt so it can become part of the inventory of my limited partnership, and all I need is the $20,000. The other $12,000 I just saved, and I can use it to go on a cruise to Bermuda or something like that. So the deal is, what you need to do is have the mindset of what am I doing that's already basically a business expense, a business that benefits the business. And that's what we help you do, is we help you go ahead and see what it is that we can transfer over legally to make sure that the right entity is paying the business, paying the taxes. You'll be able to see what is appropriate. You don't have to do anything extra over what you're doing. You may, because you now have this extra money, want to do more things than you've been doing, and that is good. So the deal is, that is what we do on the tax planning. We give you ideas of ways to be able to take more and more tax deductions legally so that you're paying the taxes that you're required to, but not what somebody else should be paying. That's what our goal is. So next time we get together, we're going to talk about what we need to do, some special things that we put into our estate tax documents to be able to keep the state from taking our assets after we're gone, or if we go into a care home or something like that. So look forward to that, and we'll go ahead and get more information for you on that. See you later.